Number 321.
Mm-hmm. Three, two, one.
Good afternoon. This is Scott Jones, Director of Business Development for iSectors. I'd like to thank everyone for attending our second quarter performance update. Today, we will be providing everyone with an update on our second quarter for all the iSector models. Our host today will be Chuck Self, Chief Investment Officer of iSectors. Chuck will be providing everyone with an update on all the iSector models and conclude with a mid-year update on the economy. The call should last about 15 minutes with Q&A to follow. Feel free to ask any questions during or after the presentation by clicking on the chat box in the upper right-hand corner of your screen and enter your questions. A recording of this presentation will be available on our website tomorrow morning at www.isectors.com. All you need to do is click on the iSectors blog icon, and you will then be taken to a link where you can access the recording. We will also be sending a link to a recorded copy of this presentation to all webinar attendees immediately after this call. So without any further ado, I will now turn the call over to Chuck.
Thank you, Scott. Well, the iSector strategies have done very well in the second quarter. The post-MPT allocations, both growth and moderate, significantly outperformed their benchmarks. The chart to the right shows you how the post-MPT growth strategy has performed since its February 2005 inception and has handily outperformed the stock index and a 60/40 stock bond index. In fact, for the 3-year period ending June 30th, 2014, both our growth strategies and moderate strategies have been top-ranked strategies in the Morningstar universe of 675 ETF investment strategies. These strategies have benefited from an overweighting in energy and gold mining securities, and we continue to have that those overweightings in the portfolios. The portfolios are also overweighted in the finance sectors and are benefiting from the low interest rate environment. The allocations are underrated in two of the sectors that have been the best performing sectors so far this year, both utilities and real estate, as people have sought the high dividends from those sectors, but our models are indicating that they are fully valued at this point in time. And also the model is negative on bonds, believing that interest rates are going to rise. So if you have clients that need an all-weather alternative, you should be considering the post-MPT allocations for that. The endowment and liquid alternative allocations also continue to perform well over the long term. The endowment allocation itself slightly underperformed the 60% stock, 40% bond index, since both stocks and bonds outperformed alternatives in the second quarter. But the liquid alternatives significantly outperformed the hedge fund alternatives, and of course you have complete liquidity with that allocation compared to hedge funds. As you can see on the right, the energy sector has performed quite well. This is a chart of the Morningstar Global Upstream Natural Resource ETF, and it was up almost 10% for the quarter. They also not only did the energy perform well, but precious metals did well in the second quarter. Both of these allocations are broadly diversified with 30 liquid alternative strategies in the liquid alternative allocation and 50 strategies in the endowment allocation. So if you're looking for diversification in a client portfolio, you may want to consider the liquid alternative strategies. The emerging market has helped power our global allocations. We have 5 global allocations which start with all the way from global equity to global fixed income as far as the ends of risks, and then 3 other allocations in between that have a mixture of both fixed income and equity. We also have a domestic equity allocation that has done very well, as you can see from the returns on the right-hand side, and because it's overweighted in dividend-paying stocks, dividend-paying ETFs, it has a very global presence as far as sales are concerned. So it's also a equity position that you may want to consider. In a quarter, dividend holdings underperformed the growth side, and since growth is underweighted in these strategies compared to dividend strategies, the allocations slightly underperform the benchmarks. But as you can see, compared to the Morningstar strategies median and the all country world index ex-US, both of these strategies have done well on the equity side. The fixed income side also underperformed because it was underexposed to long duration US Treasuries. With interest rates declining like they have during the quarter, owning long duration US Treasuries was the best performing sector, and in fact they went up 5%, just slightly behind what the S&P 500 did for the quarter. But they still performed well. They have exposure to corporate and high yield securities, both in the developed markets and emerging markets. And both the emerging market bonds and stocks rebounded in the second quarter. The inflation protection and precious metal allocations continue to perform well also. They significantly outperformed the CPI benchmarks, the inflation benchmarks. The chart on the right is one of the holdings that are in both of these allocations. This is a closed-in mutual fund that owns the actual physical precious metals. And even though it was a wild ride in a quarter, it turned out okay. As you can see in the first 2 months, especially towards the end of May, the security dropped almost 5%, but then in the month of June, it increased 10% and ended up contributing to the quarter. We use closed-end funds for our commodity allocations when we can, because this allows us to own securities that will not be taxed as partnerships. One of the weird things about our tax laws is that commodity ETFs end up being taxed like partnerships, and thus you end up, your clients end up getting K-1s and complicating their taxes. By owning the closed-end mutual funds, then they can issue 1099s and like all the other securities in their portfolios. In the liquid alternative, liquid alternative strategy, the energy portion helped inflation protection. We're starting to see nascent inflation fears. You may have seen that in the GDP report yesterday, that the implicit price deflator is now up 2% year over year, one of the highest values it's been for a while. So you may want to consider having inflation protection for your clients' portfolios. If you have clients with $300,000 or more, they should have at least a 5% position in one of these models, and because we have a $15,000 minimum in them. And between inflation protection and precious metal, you can give your clients a little insurance on the inflation side. The capital preservation allocation continued to perform well. As you know, this is an enhanced short-term cash alternative. And compared to short-term government bonds over the past 3 years, it has handily outperformed the short-term government bond index, and it continued to do so in the second quarter. This is a high-quality portfolio with an average quality of A, so we're not reaching down into the junk bonds for a large portion of the portfolio. There's a small part in there, but for the most part, it's an investment-grade portfolio with a current yield of 1.7% and a duration a little over 1 year. And so if you have clients that have intermediate cash needs, that they're not going to need the cash for a while, they have the potential of earning significantly more than they would just by owning money market instruments. And finally, we have the tactical allocation that we manage. They rebounded in the second quarter too, having positive returns. As you can see from the chart on the right, the emerging markets equity stocks, which are in the green, did very well compared to the European stocks, which is, of course, in part of the developed market that was in the black. The tactical international allocation had a significant weight in European securities, but in the course of the quarter got rid of all of them and are now focused on value sectors and precious metal stocks and Canadian stocks, which are mainly resource stocks. The tactical global balance allocation is now fully invested in all of our asset classes, including stocks, bonds, real estate, and commodities. So before I finish my comments, I'll make some brief comments on where the models see the markets going. As you know, we don't make market or economic forecasts. We have quantitative processes to put in a large number of inputs to help us set our portfolios. And our models are indicating right now that the stock market still has a ways to go in its bull market. The models are very bullish, and on the bond side, they're bearish, and in fact, they're getting more bearish as time goes on. And of course, interest rates are at recent lows, and so this is certainly not the time to be investing long-term in bonds according to the models. We think interest rates are going to be going up. As far as sectors in the stock market is concerned, the value sectors, like the ones that we mentioned earlier, are the sectors that the models are focused on. And usually, when the value sectors are outperforming, you're in the last third of the stock market. So we're probably closer, a stock market rise. So we're probably closer to the end of the bull move in the stock market than the beginning. So it's going to be very important that for your client portfolios that they have ways to be protected when the stock market ends, and using a combination of the models that we talked about today, you can help your clients get to that position. With that, I'm going to turn it back to Scott.
Thank you, Chuck. That was very informative. One last item that we need to provide you before we begin the question and answer session is iSectors disclosure statement, which you can see on your screen. Now, if anybody has any questions, feel free to just click on the chat box in the upper right-hand corner of your screen and enter your questions. We'll now begin to take questions from the audience.
Are there any questions from the audience?
Well, it looks like there are no questions, so if something does come up later on that you'd like to ask us, feel free to contact either me or Chuck. I can be reached at 800-869-5184, and Chuck can be reached at 920-257-5168. So this will conclude our second quarter performance webinar update. As a reminder, a recorded copy of this presentation will be available tomorrow morning on our website at www.isectors.com. All you need to do is click on the iSectors blog icon to obtain a link to the recording. And like I said previously, we will be sending out a link, an email with a link to accessing a recorded copy of the presentation immediately after this call. I want to thank everybody for joining the call again, and I look forward. Oh, we did get a question. I have a claim in the post-MPT growth model. That's the question, do I need to move to something more conservative?
Well, thank you for the question. What we believe you should do is make sure that your client is in the model that has the proper amount of risk that they're willing to take. It's going to be our job that when the market is starting to top, to make the models more conservative. In the declines that we had a few years ago, the model, even the post-MPT growth model became more conservative, and so it allowed clients to guard against most of the downturn, but yet they were then ready to participate in the upside. So as long as the client's risk objectives have not changed, then keeping it in a post-MPT growth is the right thing to do. And also, right now, our models are still very bullish, so you'll want to make sure that the clients are fully participating in the current bull market.
Thank you, Chuck. Is there any other questions in the audience? Okay, with that, we have no further questions, so we will now conclude the webinar. Again, if you do have a question that comes up later, feel free to contact either me or Chuck, and we'll be more than happy to address your questions at any time. So with that, we will now conclude the webinar. Thank you very much for attending.